Again, good morning, everybody. Good morning, Tyrone. Good morning, O'Neill. And to the NLB family, National Legacy Builders, good morning. Good morning to the Rise Up Financial Agency team. I appreciate you guys staying on here and rocking with me. And what I am going to do is get started with today's training, which I am going to be talking about the appropriate uses of life insurance, right? What do I mean? Well, first, there's three different types of life insurances that you could use: term life, whole life, and universal life, right? So I'm going to explain the differences, and then and then it'll become interactive where I'll throw out a scenario. You guys can create a scenario on the spot, and then we'll talk about which options would be the best options for the client, right? You always want to try to give clients at least two options. If you start giving them three and they don't understand life insurance in general, then you're going to confuse them, right? So it's up to us as the financial professionals to make sure that we narrow it down based on what the client's needs are and their affordability and their understanding of life insurance, right? Because in some cases, a universal life may be the most appropriate, but if the client has little to no experience with life insurance, they're going to be mad at you at some point because they're not going to understand how it works, right? Or if a client, has a low budget, they may want a term. We'll talk about the different options here in just a few, but I wanted to make sure that was able to get on this training and share this information with you guys. All right. Um, Before I get started, do you guys have any questions before I go into it?
You just hung up.
All right. So Tyrone, I'm going to mute you.
I
And
don't know what
if you
happened.
need to say something, then just unmute yourself. Okay.
Back to the.
All right.
Okay. Cool. And O'Neill, you're still here with us, right? Just making sure you're still rocking with us.
Yeah. I'm hiding under the closet. I'm here.
I appreciate it. I appreciate the dedication to even be on the job and still tune in. It means a lot, bro. So, all right. So
Of
let's get
course.
started. Thank you. Thank you. So let's talk about the three different types first. That's the first thing we're gonna do. So this is the way I explain life insurance, the different types to all my clients. And I hope that you guys are able to do the same thing or learn from this and explain it in a way that best works for you. When I explain it, I usually explain it almost like real estate because most people have basic to uh, you know, novice level of understanding when it comes to real estate. So this is how I explain it, right? Term life insurance, right? It is the most popular version of insurance. And here's why. Um, Term life insurance is the cheapest type of insurance. It's the lowest cost per dollar, right? Term life insurance, because it's the lowest cost per dollar, it literally means you can buy the most insurance for the cheapest price. With most companies, depending on who you use, it's also convertible to a whole life or a universal life, right? So term life is a lot like renting an apartment. You own it for a specific number of years, and then after that, you give the keys back, right? So when you rent an apartment, usually you lease it for 1 year to 2 years, right? After your 2 year period is up, you have the option to renew it, or you have the option to give the keys back and move on, right? You can go to another company. If it's a policy, you can go to another home or another apartment if it's an actual apartment. So it works just like that, except with life insurance, the term of your rental is generally 10 years. And depending on your age, it usually can go up to 30 years. So that's how that works. Within that time, because term life insurance is considered a temporary policy, you can convert it to a permanent policy, which would be whole life or universal life, right? The part that's not so great about term life insurance is the fact that it's temporary, right? You're renting a policy. And also there's no cash value growth. So those are the two not so great parts, right? But not necessarily a bad thing if you're using it for its appropriate measure, okay? Then there's whole life. Whole life is a very popular type of insurance because it's literally your whole life, right? It's going to stay with you until age 100, and some companies will cover you till age 120, depending on which one you use, right? Part of the NLB and the Rise Up family, we primarily use Emeritus. Emeritus will cover you up to age 120. But you don't have to make any more payments after age 100. So that's really good features, right? So let's talk about whole life, right? You have guaranteed cash value growth, right? You have a guaranteed minimum level of cash value growth. It covers you till at least age 100. And as I mentioned, sometimes it'll go up to 120. And the premiums, meaning the payment you make each month, is set set it and forget it. What you pay on day one is what you'll pay on day 2099, whatever. It's the year 2022, you'll pay the same price in the year 2062 if you still have the policy, right? It never changes. You guarantee cash value growth, and that rate will always beat what you get in the bank, but it will fluctuate with what bank rates are as well. But you have a guaranteed minimum, so you know that you'll never lose with a whole life policy. Now, the drawback to whole life, it is the most expensive type of insurance, meaning the cost per dollar is the most. And the reason it's the most is because everything's guaranteed. Anytime you buy something with guarantees, they're charging you for those guarantees. They're charging you for the fact that your policy is never going to change. They're charging you for the fact that you have a guaranteed cash value growth. They're charging you for the fact that the policy is going to stay with you until 120, right? But if you buy it while you're young, or young enough, I should say, it's worth it because you never have to worry about insurance again. So that's always a great option to have when it comes to making sure that you have whole life insurance, or just insurance in general, I should say, for the rest of your life. So when I explain this to a client, I explain it to them as if they're buying a mortgage on a house, right? When you buy a house, for most people, the idea is you plan to stay in that house and pass it on to your children, right? Meaning you plan to stay there for the rest of your life. Of course, unless you're a real estate expert. But ideally, you will be staying in that home the rest of your life, and you expect it to be there when you leave this earth. Well, that's how whole life works. As long as you make your payments every month, it's going to be there when you go, unless it burns down, of course. But with whole life, it will be there, right? The company will be there. And even if the company was to go under, another company would take over your policy. So you have nothing to worry about with whole life, right? It's guaranteed cash value. With the cash value, you can even borrow from that cash value after your first 2 years, right? The first 2 years of any life insurance policy, there's not really any significant cash value growth because it's considered your contestability period. Another word that I use for it is your dating period, right? You're not married to the policy just yet, because what happens is during that contestability period, a company can go back and review your health to make sure that you didn't lie on your application. Now, after 2 years, you're married. They can't get rid of you. The only way you're getting rid of them is if you just stop paying for the policy, right? But you become married to the game. You become married to that policy, and they will cover you for anything except for fraud. right? That's the only thing that they will not cover you for. But if something happens to you after your 2-year period, you're covered. So that's how whole life works. Now, let's talk about universal life. And I'm going to pause for a second to just say this. Universal life is a very, very in-depth type of policy, right? A lot of people can't sell universal life because it's so in-depth. A lot of people don't want universal life because it's so in-depth. But if you know how to set up a universal life policy, if you know how to use a universal life policy, it can be the most powerful insurance that you have because of its flexible options. All right. So let's get into it, right? With universal life, you have flexible premiums, meaning you have the option to pay what is your standard payment, which will guarantee that your policy will last up into your expected age, which for most men, it's about 81, 82. For women, it's about 85, right? So if you pay your standard payment, it should last up until that point, right? The second payment option is to have a minimum payment, which with your minimum payment option, it's kind of like a hardship payment. So let's say you're going through something, you lose your job, or you just all of a sudden have a lot of expenses that you need to kind of use your money towards, right? With the universal option is you can make your minimum payment, and it'll keep your policy in force, but it's not going to last you until your expected age. Why? Because universal life is heavily dependent on the cash value growth, which I'll get into that in just a minute. So that minimum payment option is there really as like a hardship payment so that you can keep your insurance intact, but at the same time save a little money when you're going through something. But you don't want to continue making your minimum payment because your policy will implode after a couple of years, right? The third payment option is the option to overpay, right? Because with universal life, remember with the flexible premiums, you also get flexible cash value growth options, okay? Meaning, depending on what you decide, your cash value growth can significantly increase over time. And if you want to take advantage of that and the fact that cash value growth inside of a life insurance policy, you can get that money back tax-free. That's a great option to use as an investment. This is literally using life insurance as an investment, right? So now let's talk about the different rates. There's 3 different ways to have your cash value grow inside of a universal life policy. First off, the first rate would be a bank rate option, right? The bank rate option is similar to what you're going to get in the whole life option, right? Basically, your rates are going to mirror what you get inside a traditional bank account, but it's always going to be higher than the bank, right? But it's not going to be much higher. Like if the bank rates are 1%, you'll probably get maybe 3 to 4, which is still great. And that's still a lot better than what you're going to get in the bank, but it's not exactly great. You know what I mean? Like 3-4%, not the greatest rates, but better than what you're going to get in the bank, right? Especially being that you can get the money back tax-free. Okay. Looking at the second option for cash value growth would be an index rate. Now, the index rate is essentially based on a mutual fund in the market. Most index rates are based on the S&P 500, right? Which is a stock market mutual fund. It's considered the standard of mutual funds, and it's what's generally used to compare other mutual funds. They always compare them to the S&P 500, which is basically a group where they look at the top 500 companies in the US and they invested in ownership in those companies, right? That's how the mutual fund works. So what you get with an index rate is they're going to pay you a rate based on the S&P 500, but you're not actually invested in the S&P 500, right? So, and the reason they do that is because with an index, there is a cap rate and a floor rate, all right? What does that mean? A floor rate is simply meaning this. If the market is doing bad, and generally if people are losing money, you have a floor that you can't go lower than. So if everyone is losing 5, 10, 20%, your floor rate on an index is 0, meaning when everybody else is losing money, you won't lose any money. So that's a great feature, right? But it also has a cap rate, meaning generally that cap rate is anywhere between 5 to 10%, depending on how aggressive you chose, right? So when everyone's getting 20% in interest because it's a great year, you're only going to get 10%, right? So it's a good, it's a little give and take. When everybody's losing, you don't lose. When everybody's winning, you can still gain a portion of the win, but you don't get the full win because it covers you for when you lose. So you can either get 0%, you can get up to, could be 10% depending on who you use as far as the rate, but you never lose. So that's the advantage of an index, right? It gives you the option to gain, and obviously you'll beat any bank rate, but it protects you against loss. And this is a very popular option as well when I'm talking about index rates when it comes to mutual funds in general, or when it comes to retirement options, and a lot of different things. And I'll get into that on another training. And then lastly would be the investment grade options, right? Before I get into that, let me just pause for a moment. Tyrone, O'Neill, or anyone else, if you have questions, please, stop me now and let me know what questions you guys might have.
No, I'm good.
Thank you, O'Neill.
Yeah, I'm good. Go ahead. You're doing great.
Okay, thank you, Tyrone. Appreciate it. All right, so now let's talk about the investment grade, right? Now, the investment grade option, this is the option where they actually put your premiums into one of the mutual funds. It's not just the S&P, it'll give you a whole list of different mutual funds that you can invest into. You can invest into multiple mutual funds. And this one has the ability to have the highest growth potential, right? But when it's actually invested in the mutual funds with the investment grade option, you can lose money. So the risk versus reward is increased. So there's no floor if there's a loss, there's no floor. So if the market is losing, you lose. But also, if the market is winning, however much is winning, is how much you're going to win, right? It's full participation in the growth and the loss. So that is the investment grade option with the universal life. All right. Now that I've explained the different options of the cash value, let's talk about how the cash value works inside a universal life in general, right? When you buy a universal life policy, there's really no guarantees in a universal life, meaning it doesn't guarantee that this policy is going to last you up until age 100 like it does with a whole life. There's no guarantee that your payment's not going to change. There's no guarantee, unless you choose an index rate, that you won't lose money, or a bank rate option that you won't lose money, right? So why would I choose universal life? Simply because it has the highest cash value option, right? So the way it works within a universal life policy is you make your payments every month. A portion of your payment goes to your current premium, and then the cash value is saved up to go towards your premium later in life. because as you get older, the cost of insurance actually increases. In a universal life policy, the cost of insurance increases, right? It's not guaranteed that it's going to stay the same like it is in a term or whole life, right? It's a lot like buying a condo or a co-op, right? You own it for a long term, but fees can change, taxes can change, things can change, and it can cost you more later. But we have no way to predict that it will, right? We can only adjust and see that it could stay where it's at. It could go lower, but over time, generally things get more expensive, right? So that cash value growth is meant to assist with your payments as you get older. Because if you buy, let's say you buy a policy, you're 30 years old, right? And $100,000. Now, I don't know what that payment is, but let's just say that payment's $100 a month, right? By the time you're 60, that payment is actually much more than $100 a month. It's probably double by that time. But instead of passing on the cost to your monthly payment, what the insurance company will do is pull from the cash value growth to pay your premium, so that ideally you won't have to cover the difference, right? The things that could hurt you though is if you have never put any extra money into it, or let's say the market was down, then the policy can implode because there isn't enough cash value. And that's what can hurt you when you only make the minimum payments. But let's say the market did great over that 30-year period, right? If the market did really well, you could have it where the cash value pays for the policy itself, and you don't have to make payments each month because the cash value did so well, it can pay for itself. So that's the give and take when it comes to universal life. Now, again, this policy is very, very hands-on for the consumer. So it's not right for most people, but for the savvy person who understands their finances, such as an insurance agent or someone who's in finances, such as an accountant, a CPA, people who really understand money, this actually is a great option for them because they're going to be on top of it anyway. But someone who has no experience with insurance, no experience really with investing, probably not the best option. All right. So now let's talk about a few scenarios, right? And this is where I want you guys to get interactive. And I'll ask Tyrone to go first, if you don't mind, Tyrone. Create a random scenario, right? I'll take a few notes and we'll talk about what would be the best option for a client. Or you could even give me a current client that you're working on where, you may want to say what would be the best option based on the scenario. I'm going to leave that totally up to you. And then we'll talk about, how we would best help that client. All right.
Okay, and you want to do it in a universal policy?
No, we're not going to talk about the policy. We're just going to talk about a client scenario. And then based on what that client's needs are, we'll narrow it down to which policies could be the best for that person.
Okay.
So you can
All
say like it's a 35-year-old female, income of 100,000, 3 kids. Boom, we'll go from there.
I got you. All right. I got a 40-year-old female, 2 kids, a divorcee. And when she did the divorce, her husband actually canceled the family policy. Now she wants to take out a $150,000 policy on her and the kids. $100,000 for her, and roughly $25,000 for each one of her kids. That's great. All right, and she wants something that's going to grow value, have some value within it. And
What's her
And what
income?
she's looking for the kids is that something that's going to contain them actually when they get older, they can take it over for themselves in that perspective.
Okay.
Okay.
Do you have her income?
Well, yeah, she roughly making 85 a year now. But her and her husband together was making something like maybe 160, 170,000 a year. He was the most breadwinner.
Okay. So now she's by herself,
Yep.
2 kids,
Mhm.
no life insurance. She's looking for specifically 150K for herself and about 25 for the kids.
Correct.
Okay. And then you said she wants cash value.
Correct.
Okay. So let's talk about this, right? So let's look at a couple of important factors, right? It's really important to read between the lines when you are working with clients, because what they're going to tell you things without telling you things, right?
Mhm.
So first off, she's a divorcee, right? Which means all of the bills in her house are on her. That means the rent money is on her, the kids' schooling is on her. And since she's divorced and the father's probably not there, she's gonna have other expenses such as babysitting. You know, she's got to buy the kids clothing. She's got to buy clothing for herself. If she owns a car, that's a car payment and car insurance, and then just groceries, right? So
Right.
with all of these factors, you want to make sure that the policy is affordable for her. Now, a client will tell you, I want 150K, but when you show them the actual cost, they may decide to do less. They may decide to do more. You don't know. So that's why you always want to approach them with at least 2 options, right?
Mhm.
This 40-year-old, did she tell you what she does for a living?
Well, yeah, she's a legal secretary.
She's a legal secretary. Okay, so she works in law. Got it. Okay. And do you know if she has any investment experience?
None at all. Her husband took care of all of those.
Okay. Okay. Very key point, right? So now we got enough to give a really good scenario on how this is going to work, right? So first off, one of the most important things, some very important factors, is that she's a divorcee. She has no investment experience. She has 2 kids that she's basically raising on her own, and she has no life insurance at all, right?
Right. Mhm.
So when someone tells me they have no investment experience, I'm immediately not talking about universal life. Immediately, because they're not going to understand how that works, right? It's a very complicated product, and I would never recommend that to someone with no investment experience, because it's just not the right thing to do, right?
Mhm.
Secondly, being a divorcee, she's a single income. You said 85 a year with 2 kids. It sounds good, but if she lives in New York, that's not a lot of money.
There's not a lot of money.
In the US period nowadays, 85 is good and you can live on it, but she's on a tight budget,
Mhm.
right? She's not taking trips every month.
Yeah.
You know what I mean? She's just above check to check, right? She may have a little bit left depending on how she manages her money.
Right.
And since she's divorced, she's probably had to dial things back a little bit because of the loss of income. So my first option that I'm going to look at when it comes to working with this client, since they want cash value growth, I will show them the whole life option, but
Oh, yeah.
I'm going to lead them towards a term option, or
But why did
sorry, you want me to?
Go ahead. I'm sorry.
No problem. I'm going to meet you, so that O'Neill can hear. and that we can continue, right? So she has all of these things, factors, right? So I'm going to show her what a whole life policy looks like, right? And it's going to be pretty in depth. It's going to be pretty expensive for her to afford this by herself, especially since she's also looking for policies for her kids, right? With all of these factors, that's going to be a lot for her to try to maintain by herself, to try to do a whole life. But again, you got to give a client what they want, but show them two options. So I'm going to show her the whole life, but I'm also going to show her the term policy, right? Now, the first reaction that I normally get is everybody wants whole life, but they want term pricing, right? Everybody wants to drive a Benz or a Beamer, but they want Hyundai pricing.
That is so true.
It's just, you know, it is what it is. I want that. I know it's not possible, but I want that. You know what I'm saying? So you show them both, right? And then sometimes what'll happen is you'll come across a scenario where they can't decide on what they want to do because they really want the cash value, but they don't want to pay for whole life pricing. Totally understandable. You, ma'am, this is what I'm going to do for you. I'm going to show you a whole life policy for $50,000 or even $25,000, and we're going to add a term rider for the difference, right? This way you do earn some cash value, and for the rest of your life, you at least have this $50,000. But in addition to that, you're going to get this term policy for $100,000 to cover the difference, right? Generally, 9 times out of 10, they will eat that up because you saved the money from whole life, but you also gave them a term rider that will cover the difference in the amount of insurance that they need, right? Also, because you saved the money on their whole life policy, they now have an idea and they have room enough to buy 2 more policies for the kids. Because here's what you can do. You can add the kids as riders on her existing policy. The issue is that rider is only going to cover them up to age 18. Now, if she wants the policy to last past that, no problem. We can get them a whole life policy for $25,000. And let's say that the kids' ages are, I don't know, 6 and 9, right? They're only going to they'll pay less than $40 a month for each policy. And her policy will probably cost her in the range of about $100 a month. You know, I try to keep the policies usually between $100 to $200 a month, because more than that, people start questioning, am I going to keep this policy after about 2 or 3 months, right? Especially if she's single. Now, if she had both incomes, she would spend that $250 a month with no problem. But since she's by herself, you want to try to keep it affordable. So you do a whole life with a term option to give her the best of both worlds. Does that make sense, Tyrone? You're muted.
Yeah, that makes sense. I was still on mute. Sorry about that.
No problem. How do you feel about that scenario? How do you feel that sounds for the way that I did that?
That sounds good. You give them 2 options. Of course, we already know on top of our head, $150 whole life policy is going to be a little expensive,
Right.
Plus with the kids, and that. So yeah, give her, like I said, $25,000-$50,000 whole life, something that'll grow. You can add the kids as a rider, maybe somewhere down the line before they turn 18, her income may grow a little bit. Sorry about that, man.
Yeah, no problem. Listen, it's okay, man. We all work from home.
Hello, this is Tyrone. Can I help you?
You got family, so I'm gonna mute you while you take that call. But yeah, so that's a great scenario. Thank you, Tyrone, for giving us that information.
Is that also called layering? Or
It
is
is.
that a different term?
Nope, that's a great term. It depends on where you came from. New York Life uses the term layering, so I know exactly where you got that from. Um, I don't like to use insurance speak with the client, so I'll say something like, "Let's do a combo meal," right? Let's get you a little bit of both.
Combo meal. Funny.
It
But
is.
they could relate to it though. They could
They
relate
can
to it.
relate because they know that they're getting more than one thing in with one payment. They know they're getting a nice cheeseburger and the fries and drink, for $8.99 or whatever, right? So you're giving them a combo meal where you're giving them a cheeseburger whole life or a premium chicken sandwich, and then you're giving them term where they're getting the fries and drink, right? So they're getting everything that they want and more for less than if they bought it individually. So layering is a great term, depending on who you, obviously, if you're speaking with a high value client, use insurance speak because you want to sound smarter.
Right, right.
Use insurance speak. You also got to judge who you're talking to. Or you could say both. Say, listen, one thing that we do within the insurance industry is we like to do something that we call layering, where you get more than one policy inside of what we do, where we're going to combine them. Another term for it is a combo meal. You can say it like that. And whichever one they understand, great. As long as they understand what's going on, it doesn't matter. So that's a great way to give a client the best of both worlds. All right. Thanks, Tyrone. Let's look at one more situation because I don't, we've been on here about 40 minutes or so, and I don't want to keep you guys all day, especially with O'Neill being at work. Let's look at another situation. O'Neill, do you want to create a scenario?
Yeah, sure. Go ahead. Go ahead, Joe.
No, I want you to create.
So we're looking at Mr. and Mrs. Joe Doe.
John Doe and Jane. Okay.
Right. They're a married couple with 2 kids. They have a combined income of $275,000 a year. They have a monthly expenses that go north of $8,000 a month. They have, I said 2 kids, right? One will be entering college in the next 2 years. Mr. Doe is an accountant. Mrs. Doe is a legal secretary.
Okay, hold on.
They want to live well.
Mr. Doe is an accountant. Okay.
Mrs. Doe is a legal secretary.
Okay.
Their goals for the future is to live well in retirement and possibly purchase a vacation home in Spain and pay for college.
Live well in retirement, purchase home in Spain, you said?
That's their retirement goal. They want to live well in retirement. One of their goals, one of their bucket lists is to purchase a vacation house.
Got it. Okay. Great scenario. All right. And thank you for having everything that could be a scenario. You can tell somebody that knows how to profile a client. So that's a really good IQ in there. And I'm not saying that you don't, Tyrone. Let me make sure that you understand. I'm not saying that at all. But O'Neill, that was
Tyrone's a rock star.
He is a rock star. He is. So let's talk about that, right? John and Jane Doe. I'm going to recap to make sure I got it all. John and Jane Doe, married with 2 kids, income of $275, monthly expenses of $8K. They have 1 kid in college, and the other one, let's say he's in high school. Mr. Doe is an accountant. Mrs. Doe is a legal secretary. And their goals is they want to live well in retirement, purchase a home in Spain, and pay for their kids. All right. Pay for the kids' college, excuse me. Excuse me. All right. So here's an idea. Now, because in this scenario, They definitely did not mention how they definitely didn't mention what is the most important type of insurance. But with Mr. Doe being an accountant, I'm sure he has investment experience, right? Um, Mrs. Doe is a legal secretary. May not have experience, but she could because her husband is an accountant, right? But more than likely, he handles the finances. With the combined income, legal secretaries generally only make about 60 to 80,000 a year, 100 if it's a really dope law firm, right? So Mr. Doe probably has income close to 200,000. So he's the main income and the main financial person. Um, Two kids in college, and they want to purchase a home in Spain, and they want to live well in retirement. Great. Let's talk about it, right? So since we didn't get into their what they actually have in investments, that's okay. But you can assume they have some, right? With him being an accountant, you can almost assume that they have a nice size investment portfolio. So with that income that they have, let me just pull out my calculator really quick. 275,000 divided by 12. So they have a gross monthly income of just under 23,000 a month, right? Now I'm going to multiply that by 0.70. And the reason why I'm doing that is because the 0.70, generally your taxes, I average taxes anywhere from 30 to 35%, right? So in this scenario, I averaged it, just said they have a 30% tax rate. You don't know what their tax rate is. He probably does, but you can always assume about a 30 to 33% tax rate. So after taxes, they're still bringing home about 16,000 a month. You guys see how I came up with that number?
Yep. I always
Yeah.
do at 33%. Yep.
Right. I normally do 33% as well, but for the sake of just making the numbers easy, I just decided to go with 30%. So now after taxes, they're getting about 16,000 a month, right? And they have monthly expenses of 8,000 a month. So they have a large window of opportunity that they could potentially invest, right? Because if they have 16,000 a month after taxes and they're only spending 8, that means they have 8,000 a month that they could do some damage with, right? Great. So now knowing that, I'm immediately going to show them whole life and I'm going to show them universal life, right? I'm not even going to talk about a term unless they bring it up, right? I mean, I'll explain that there are 3 types, but I'm going to recommend whole life or universal life. And the reason being is because they're looking to live well in retirement. They're looking to purchase a home in Spain. So essentially, they're looking for cash value growth, right?
And just, I'm sorry to interrupt, just for the, in the sake of time, could we start with the universal life as a recommendation first?
Yes. Yep. So because whole life is straightforward, right? You're going to get a guaranteed rate. I'm going to show you exactly what it could be. Here's what the minimum is. Here's what it could be, right? That's exactly how whole life works. Guaranteed minimum. This is what it could be. That's it. Now with universal life, I'm going to give them the options, right? So because they're looking for the option to have money in retirement, right? And they have a kid in college. So when you have a kid in college, I immediately assume that you're 30 years older than your kid. So that means your kid is about 18, right? And that means you're probably about 58. Could I be wrong? Yes. Could I be right? Yes. We don't know without knowing their exact age. But let's just say Mr. Doe is about 58 years old because they have an 18-year-old kid about to go to college.
Wow, Joe, that's rough. I'm thinking like, wait a minute, 58 kids in college. Damn. Yeah, I got. No, I have friends with kids in college and they're not 58. I'm like, damn, Joe, you made them old.
Well, I'm just saying, if you had a kid at age 30, could they have their kids younger? Yes. Could they have their kids older? Yeah. You don't want to assume.
I see what you mean. I see what you mean.
You don't want to assume too young because that could come off offensive, and you don't want to seem too old because that also could come off offensive. So let's just assume 30, right? Without actually knowing their birth date. When you profile them, you have that, but just for the sake of this scenario, I'm going to assume that he's 58, right? The wife is probably the same age, if not younger, right? So at age 58, retirement age now is about 67. So he has about a 9-year horizon before he would actually use the money, right? So with that in mind, I would recommend an index universal life, right? Here's why I'm going to recommend an index universal life. Because it has rates that could beat what he's going to get in a traditional bank rate option. You know what? Let me share my screen so you can guys see some of the notes that I have. Right. So you guys can now see my screen, right?
Yeah.
Okay. So I'm going to focus down in here. All right. So now I'm going to recommend an index, right? And the reason that I'm going to focus on an index primarily is because of the potential to have significant rate growth or interest growth. But because it's only 9 years, that sounds like a long time. But when you're thinking about investing, that's not a long time. And particularly if he hits, if there's a chance where the market dips, he's not going to have time to recover. So let's say the market dips 3 to 4 years in, then he's only going to have 3 to 4 years to recover. And if he doesn't recover, or if the market dips at the wrong time, it's really going to negatively impact the cash growth. So with an index rate, he'll never lose, but he'll also have the option to have significant growth should the market do well. Depending on, the company that you use, that index rate could be up to 8 or 10%. Some of them don't give that much. Some of them give you only like 5 or 6%, but that's still better than a guaranteed 1 or 2% that he's going to get in a bank rate. So he's going to have cash value growth. He's going to have the option for multiple premiums. And as an accountant, he's going to be on top of how well it's growing. And he's going to be on top of the fact that he can add more into the policy. Let's say, 1 month he decides to dump an extra 6,000 into the policy because he wants it to grow. You can do that with universal life. You can't do that with whole life or term. Only universal allows you to dump in extra money. So those are that would be a really great option for him, is to do the index rate universal. You can, however, depending on how savvy he is, you could recommend investment grade universal life as well, only because as an accountant, he is likely to have mutual funds and investments outside of what you're talking about. So he's going to understand it at a high level, right? But I personally would lead with the index because of the option and the protection that he'll never lose. Do you guys understand where I come from with this recommendation?
Yeah, so the index is not fully dependent on the market, correct?
That's right.
Right. Well, it is in a sense that it's dependent on the market to determine what the rate he's going to get, but it's protected against market loss because it's not actually invested into the market. So it's kind of like, it's almost like a combo meal. You get the best of both worlds. You get the idea of having a higher level of growth than a standard rate, but you get the protection against loss that you would normally have if you actually invested in the market. So you're protected against loss, and you get a cap rate, but which you get more growth when the market's doing well.
So the index won't bottom out.
What do you mean? Yes, he won't lose money in the
Right.
index, right? It'll bottom out technically at 0. So when everybody else is losing, he's just going to stay flat.
Right.
Okay. Does that make sense, guys?
Yeah.
Okay. All right. So now we saw a scenario where I recommended a whole life with the term life option. We see a scenario where I'm recommending a universal life, right? Now I'm going to give you a quick scenario for the sake of time where you would use a term. All right. Let's say the client is, let's say the client's 28, 30 years old, right? 30-year-old male. He's looking to get married, doesn't have kids yet, but him and his fiance are in the process of buying a home. They have a combined income of about $140,000 a year. He works in construction, and his wife to be is a nurse, right? They don't have any kids yet. They don't have any other investment experience, right? Cool. So now with the information that I just gave you guys, let's look at the important facts, right? One, they're not married yet, but they're engaged. So they're planning life together. They're planning to grow a family. They're planning to have a lot of things, and they're already in process of buying a house, right? So to me, if they're getting married, that means they're planning a wedding, which is expensive. They're purchasing a house, which is expensive. They don't have kids. They don't have investment experience, right? And they have a significant income of 140,000 between the two of them, right? So they're in the mid-level stages of their career. Him being in construction, he's probably been there a couple of years. Her being a nurse, she's probably only been there a couple of years, but they're making good enough income to really start building life together, right? Cool. Because they're buying a house and they're paying for a wedding at the same time, I am going to recommend that they get a term insurance policy. And here's why. One, they're just starting out in life, and you want to keep their expenses relatively low, but you also want to maximize the amount of insurance that they get because they're now buying a home. And unfortunately, I do have people that I know that got married, and within the first 2 to 3 years, one of them passed away. And it's a terrible situation. It could be a car accident, it could be cancer, it could be any number of things. Hell, we've seen it with COVID, right? And because they were young, they didn't think they needed life insurance, when in all actuality, by the time they saw that they needed it, the person was already sick and you couldn't do anything for them, right? And since they're young, you can't get them a guaranteed issue. So I recommend term, one, to cover the cost of the house, right? And that's why you maximize it and get it to cover the cost of the house. And if they live in New York, the house is probably going to be 400,000, right? 300 if you're in Long Island, but you got to pay taxes. So let's say 300,000 to 400,000 there. Then, they're paying for a wedding. They're going to want to have children, right? So you want to be able to cover their income for at least a set number of years as they're building a life. So what I would do for them is I would take their income, their individual income, let's say it's 70,000 apiece, right? And I would multiply that out by anywhere from 5 to 10 times their income as an appropriate amount of insurance, right? And since they're buying a home, getting married, they want to have kids, I would try to do 10 times their income, because 700,000 on someone who's a 30-year-old male in good health, he's probably going to pay, close to $100 a month. I know this because I just wrote one for a client. I just wrote one for a woman who's 35 in excellent health. She's getting $1 million policy for like $125 a month. So it's very, very doable and possible for this to happen. And it's affordable for them, right? So this is a scenario where I would recommend the term, right? And later on, they still have the option to convert some of that 700,000 to a whole life. And you let them know, say, listen, right now, we just want to maximize your coverage. We want to make sure that, God forbid, something happens. Later on, as your income increases, we can talk about converting either all or some of this into a permanent policy. So that way, 5 years from now, you say, you know what, Joe, I want this policy to stay with me the rest of my life. Cool. Let's slice off 100,000 and make that permanent. And then you still have 600,000 for the remainder of that 30-year policy, which at that point would be 25 years. And now, because you already own the policy, when we do convert it, no matter what happens to your health in that 5 years, you already own it. So there's no more health exam. You don't have to take a health exam. It's literally sign and drive. So to me, that is a appropriate use of a term policy, right?
Sign and drive.
You like the terms I'm using, O'Neal.
I'm loving these terms, man.
Listen, I do my best to not have insurance speak. I try to use simplified terms so that the client really understands what's going on. So, all right. So that's going to conclude what I'm going to talk about with the insurance and different things. Let me just close this out. Do you guys have any questions?
Good overview.
No, I think it's good. Like we spoke with Lamont the last time, to do a full illustration of the IUL and the annuities.
You said you want to do.
I think Shannon had spoke on that too at one time, so you get the full understanding of it. But yeah, that was very good, Joe. This is like a recap, of everything, man. It's great. And then some, and I was saying dim sum.
Dim sum.
Yeah, dim sum. So that was great,
Thank you. I appreciate that. O'Neal, you were saying something before. I'm sorry.
No, just to mimic Tyrone, that was a great recap, good overview, good review, good refresher, especially for the IULs. So I appreciate that. Good job.
Right.
Thank you. All right. So listen, we'll be here same time next week. Next week, I plan to talk about actually getting customers, different ways that you can talk to your friends, family, associates, random people you meet at the market, different ways to present your business and find clients, because that is the lifeblood of what we do. No matter how much knowledge you have, if you don't have somebody that can purchase this product, you don't have a business, right? So let's make sure that we're all in position, and let's make sure that we are also actively looking for clients, because listen, they're not going to walk through the front door. We're not selling burgers and fries where people come to you when they're hungry. We're selling a complicated financial product, which we're all minorities. We want to be able to explain it to them, show them the need, uncover the need, and plug in the holes, right? So that's what we do. We are financial doctors. That's quite literally what we do.
That's a good knowledge. Yeah.
We're financial doctors because the two most
Yeah.
important things outside of your physical outside of your family is your medical health and your financial health, right? So physically, you always want to go to a doctor that knows what they're doing and knows what they're talking about and genuinely cares. The same rule applies to your financial advisor. You want to go to somebody who knows what they're doing, who understands your situation and genuinely cares. And that's what we have to do. That's exactly what we have to do. Unfortunately, we spend a lot of time convincing people that they need it, but that's okay. That's just part of the education. But the other side
Mhm.
is letting people know I can provide it. You know? So this is the thing I'm going to leave you guys with, right? I want you to find 10 people this week where you're just going to tell them what you do. You're not going to try to sell them. You're not going to try to tell them they should need it. You're just going to tell them that you are a financial professional and you provide these services. All right, thanks, O'Neill. I appreciate it. This is the end of the meeting anyway. I appreciate you, bro. So just try to tell 10 people. And if it leads to business, great. If it doesn't, great, because you told 10 people what you do. All right.
All right.
All right. So that's gonna conclude our meeting. I appreciate you guys for logging in with me and rocking with me. And I will see you next week. Same bat time, same bat channel.
All right, man.
All right. Have a good one.
All right, Joe.